In this video and in the article below, you're going to learn the differences between debit cards and credit cards. Now, understand this, you need both in your life, but one is a little bit more dangerous. Now, this is what a credit card looks like, and this is what a debit card looks like. Those look pretty identical, but it is the source of the money that is so different between the two. With one, you are borrowing, and the other, you're paying directly from your account, your bank account. But let's talk about danger first. I think you know this already, but the credit card is more dangerous. Now, you'll hear the term APR thrown around. I guess you could think of it as like an interest rate. So look at this. What does a 24% APR mean? An annual percentage rate of 24% indicates that if you carry a balance on a credit card for a full year, the balance will increase by approximately 24% due to accrued interest. And it gives you the example, if you maintain a $1,000 balance throughout the year, the interest accrued would amount to around $240. 24% of $1,000 is $240. So if you get into debt for $1,000 on a credit card, you don't pay it throughout a year, by the end of the year, you're going to owe $1,240 if your APR is 24%. But you might be saying to yourself, well, $240, that's not too bad. I'll work a few extra hours. But what if you get $10,000 into debt? Well, let's solve that. What is 24% of 10,000? Calculate. It's $2,400. Now you'd owe that original $10,000 and you'd have to add this on as interest. You would suddenly owe $12,400 at the end of the year. But credit cards are really important because they build your credit history. Picture this. You see that great car that you want to buy someday, or even lease, like you need good credit to lease. And it's the history of you paying back your credit card, paying back your debts that will enable you to get that great car, or in the distant future, that great house that you want. Credit cards build your credit history. You ever have a friend that goes, "Yo, man, loan me $1. Loan me $1." Well, what happens if that friend doesn't pay you back? Are you going to lend that friend again? Oh my God, never again. Exactly. Banks think like that too. You will have a good credit score if you have a history of repaying your debts on time. And if you have a bad credit score, good luck with that. Other advantages of a credit card is they give you extra time to pay for your purchases. Let's say that you didn't have the money in your bank account, but you were about to get paid. Well, you could pay for things with a credit card. And that is especially true in the case of emergencies. So, Mr. K, what about a debit card? It's very much like paying in cash, only you're not paying cash. You're handing somebody the card, and money is getting deducted from your bank account. Like if you take cash out of your account, the same exact thing happens. When you get cash out of an ATM machine, you're taking it from your bank account and you're using your debit card. So my summary for you would be, when you use a debit card, it's doing the same thing as cash. It is taking money out of your bank account. You are not getting into debt. You're using money that you have. Credit cards, you're borrowing, and you have to pay that back. Debit cards, you are using your own money.